1 million drone deliveries already completed.
Oh, wow.
Right. A new generative AI shopping assistant that, well, essentially plans out your entire weekend. And a stock valuation multiple that is normally reserved for, high-flying Silicon Valley cloud software startups.
Yeah.
If you just heard those data points, you would probably think we were talking about Amazon, Alphabet, or Meta.
You really would. I mean, it sounds exactly like big tech.
But we aren't. We are talking about the massive boxy building located just off the interstate, where you go to buy, discounted bulk paper towels, inexpensive T-shirts, and family-sized cereal. We are talking about Walmart.
Which is just wild to think about.
It is. So, welcome to this Time and Market Deep Dive. A quick reminder for you listening that this is just for entertainment purposes, and you should always seek professional advice.
Always a good reminder.
Yeah. Today, our mission is to look at a comprehensive earnings and performance analysis on ticker WMT Walmart. We're pulling from a pretty heavy stack of sources today.
Yeah, we've got quite a bit to go through.
We do. We've got Walmart's annual report for fiscal year 2026, their Q1 fiscal 2027 earnings release, a market beat financial analysis, and a Motley Fool earnings call transcript.
And, I mean, looking at all this, the overarching narrative jumping out of this data is, quite frankly, a paradigm shift.
And that is exactly what we need to figure out for you listening today. Because, look, if you're holding WMT in your portfolio right now, you probably bought it for safety.
Right, for the dividend.
Exactly. You probably weren't expecting your grandfather's grocery stock to suddenly trade like a hyper-growth tech asset.
No, definitely not.
So our goal today is to explore how this old-school brick-and-mortar retailer is rapidly transforming into a high-tech logistics, advertising, and AI powerhouse.
Yeah.
And most importantly, we need to find out if this massive stock market valuation actually reflects reality or, if we are just looking at corporate PR hype.
It's a profound disconnect for a lot of traditional investors. I mean, the market is pricing this company as something entirely new, but the physical reality of moving millions of pallets of physical goods across the country, that's still the foundation of everything they do.
Okay, let's unpack this. Because before we can even touch the futuristic tech pivots or the drone deliveries, we have to ground ourselves in the sheer scale of their current financial reality.
We really do.
Right, because if Wall Street is giving them a premium valuation, we need to know what the baseline looks like.
Well, the baseline is almost difficult to comprehend. To set the stage, for the fiscal year 2026, which, just closed out, Walmart ended with a staggering $713 billion in total revenue.
$713 billion.
Yeah.
To put that in perspective for the listener, that isn't just a corporate revenue number. That is roughly the gross domestic product of a mid-sized country.
It truly is. It's massive. And the momentum is carrying forward, too. If we look at their current Q1 fiscal 2027 performance, revenue hit $177.8 billion for just that single quarter. Yeah, that represents a 7.3% increase. And the sources also note that this is a 5.9% increase in constant currency.
Actually, let's briefly translate constant currency for anyone who might, gloss over that term.
Sure, yeah.
Because Walmart operates globally, they collect revenue in pesos, euros, pounds, and more.
Yeah.
When the U.S. dollar is really strong, those foreign earnings look smaller when converted back.
Right.
Constant currency just strips away those exchange rate fluctuations so we can see how much the actual physical business grew.
Yeah.
And, nearly 6% growth on a base of almost $200 billion is just massive.
It's incredibly strong. And the bottom line was equally solid. Their adjusted earnings per share, or EPS, came in at 66 cents. That slightly beat the Wall Street consensus estimate, which was sitting at 65 cents.
Which brings us to the market's reaction and really the valuation metric that I find completely mind-boggling.
The PE ratio.
Yes.
Yeah.
Depending on the exact time of day you look at the sources we have, the stock price is sitting around $120.27, with some market opens pushing all the way up to $130.85.
Yeah.
That places their market capitalization at an astronomical $1.04 trillion.
Trillion. With a T. I mean, it puts them in very rare, very exclusive company.
I have to throw a massive flag on the play here, though. I am looking at these numbers, and that share price gives Walmart a price-to-earnings, or PE ratio, of 47.76.
Yeah, it's high.
Let's think about what that actually means. A PE of nearly 48 means investors are willing to pay almost $48 today for every $1 of earnings Walmart generates.
Right.
Historically, traditional retailers companies selling physical goods on shelves, they trade at PE ratios in the mid-teens. 15, maybe 18 if they're having a truly great year. How on earth is a 48 multiple justified for a company selling discounted groceries and, lawnmowers?
Well, the market is telling us something very clear with that multiple. They are no longer pricing Walmart purely as a traditional retailer.
Right.
A PE of 48 is entirely forward-looking. Investors are pricing in the omnichannel growth, the supply chain overhaul, and crucially, new revenue streams that operate with software-like profit margins.
Software margins.
Exactly. The fundamental DNA of the company is shifting, and the market is paying a premium for what Walmart will look like 5 years from now.
So they aren't just pricing in the sale of a gallon of milk. They're pricing in the underlying digital and physical system that delivers it.
Yes.
I want to test that theory. If Wall Street is pricing them like a Silicon Valley tech firm, they can't just have a nice-looking website. They must be fundamentally changing how a physical product gets from a warehouse to my front door.
They absolutely are.
How are they actually doing that?
They are doing it by essentially rewiring their supply chain to mimic a logistics and tech company heavily reliant on automation. And the Q1 numbers prove the strategy is, it's catching fire. Global e-commerce grew by 26%.
That's significant.
It is, but the standout metric is their Walmart U.S. store-fulfilled delivery, which surged by 45%.
Wait, 45% growth? Store-fulfilled delivery was already a massive part of their business. To grow that by nearly half in a single quarter requires a mechanical change behind the scenes. Human beings pushing carts down aisles simply cannot move that fast.
You hit the nail on the head. It is entirely about taking the human out of the retrieval process. The sources point out that roughly 50% of the Walmart U.S. e-commerce fulfillment center volume is now completely automated.
Let's visualize that for the listener, because it's not just a basic conveyor belt.
Oh, no, not at all.
When we talk about automated fulfillment, we are talking about massive three-dimensional robotic grids inside these warehouses.
Right.
Instead of a human worker walking 5 miles a day with a scanner to find a bottle of shampoo, robotic shuttles, often called alphabots, race across this grid, retrieve the exact bin containing the shampoo and drop it directly in front of a human packer.
Yeah.
It radically lowers the cost per unit shipped because the algorithmic efficiency is just through the roof.
And that grid system extends far beyond just the e-commerce centers. Over 60% of their physical stores now receive their freight from automated distribution centers.
Oh, wow.
So the pallets arriving at the back of your local Walmart are already algorithmically sorted for maximum efficiency when they come off the truck. This results in wild delivery speed milestones.
Like what?
Over 36% of U.S. store-fulfilled deliveries now arrive at the customer's home in under 3 hours.
3 hours. You tap a button on your phone, and before you finish watching a movie, your groceries, your electronics, whatever you ordered, they're sitting on your porch.
Yeah. And the data shows 60% of the U.S. population can now receive deliveries within 30 minutes.
What's crazy is that Walmart has over 10,000 global physical stores. Based on these 30-minute delivery speeds, it feels like they aren't just stores anymore.
What's fascinating here is the distinct structural advantage this provides over almost any pure e-commerce competitor.
Because of the real estate.
Exactly. Think about how a standard e-commerce giant operates. They have to build massive, expensive fulfillment centers from scratch, often far outside city limits where land is cheap.
Right.
And then they have to figure out how to drive the product an hour into the suburbs.
But Walmart doesn't have to do that. They are essentially localized micro-fulfillment warehouses hiding in plain sight. You walk in the front door to buy a loaf of bread, but in the back, it's a high-speed logistics hub serving the entire zip code.
Yep.
If I want a blender from a traditional online retailer, it comes from a warehouse 50 miles away.
Yeah.
If I want it from Walmart, it comes from a building 2 miles down the street.
They are leveraging real estate they already paid for decades ago to solve the most notoriously expensive part of e-commerce, which is, the last mile delivery.
I cannot let us move past last mile delivery without challenging the most futuristic detail in our entire stack of sources.
The drones.
The drones. The reports state Walmart just completed its 1 millionth drone delivery. I have to be the skeptic here. 1 million drone deliveries.
That sounds like a lot.
I haven't seen a single drone dropping off paper towels in my neighborhood.
Yeah.
Are they actually doing this at scale, or is this just a PR stunt in a few test markets to make them look like Amazon?
It sounds like science fiction, I know, but the volume is real, though it is highly localized. They are currently operating these drone hubs in 66 locations across 4 states.
Okay, so it's concentrated.
Exactly. So unless you live in one of those specific zones, you wouldn't see it. But the adoption curve inside those zones is going vertical. The data shows that 40% of those 1 million drone deliveries happened just in the first quarter of this year.
Okay, here's where it gets really interesting. Because delivering groceries via drone, or even paying a driver to rush them to someone's house in under 3 hours, is incredibly capital intensive.
No, absolutely.
It eats into profit margins. So if they are spending all this money on robotic grids, localized fulfillment, and drone fleets, how are they expanding their profit margins to justify a PE of 48? You mentioned earlier that the market is pricing in new revenue streams. What are these new side hustles?
This is the absolute crux of why they are getting that tech valuation. They're pivoting to where the real money is: advertising, AI, and memberships.
Let's break those down.
Let's look at the advertising engine first. Global advertising revenue is up 37%, and Walmart U.S. advertising specifically is up 36%.
I want to make sure the listener understands the mechanics of this because it's brilliant. Think of Walmart's traditional grocery business like a toll booth that makes literal pennies on every physical car that passes through.
Right.
It's a low-margin grind. This new retail advertising business is like putting up massive digital billboards all around that toll booth. When a brand like Kellogg's wants their new cereal to show up first when you search breakfast on the Walmart app, they pay a premium.
A huge premium.
And the cost for Walmart to put up that digital billboard is basically zero, but the revenue from Kellogg's is almost pure profit.
The margins on that digital real estate are nearly 100% compared to the razor-thin margins of the physical groceries themselves, and it pairs perfectly with their membership push.
How so?
While global membership fee revenue grew 17.4%, with Sam's Club US up 5.6%.
Of course. Once you get someone to pay an annual subscription fee, consumer psychology takes over. Exact.
They are locked in. They are going to buy everything through you just to justify the cost of the membership they already paid for. It's recurring, high-margin revenue.
It's a very sticky ecosystem.
But the wildest part of this digital shift, to me, is the AI component. The sources highlight a new generative AI shopping agent Walmart introduced named Sparky.
The internal metrics on this AI agent are just incredible. Weekly active users of Sparky jumped over 100% quarter over quarter.
Wait, 100%. But how does Sparky actually work in practice? Because a lot of companies just slap the label AI onto a basic search bar.
Right, but this is different. It completely changes the user interaction from a search-based model to a solution-based model.
Okay.
In the past, a shopper might search for paper plates, add them to the cart, then search for hot dog buns, add them, then search for charcoal.
Very manual.
Exactly. With Sparky, the user simply types a prompt like, I am hosting a backyard barbecue for 15 people this weekend.
And it just knows. The generative AI understands the context and instantly builds a comprehensive cart with plates, buns, charcoal, specific meats, side dishes, and even sunscreen.
It does all the thinking for you. And I imagine that leads people to buy things they didn't initially plan on, right? Like the sunscreen.
The data proves it out. The average order value for a Sparky user is 35% higher than a regular shopper.
35%.
Yeah, furthermore, the total units purchased through Sparky grew more than 4 times sequentially.
So if we pull back and look at the big picture, how does this fundamentally change the business model for the listener who might be investing in this stock?
Well, for decades, Walmart monetized the sale of physical goods. They bought low, sold slightly higher, and made a tiny margin on billions of physical transactions. Now, they are monetizing attention.
Monetizing attention. I love that phrasing.
They have 280 million weekly customers. That is a captive, high-intent audience. By selling third-party marketplace ads to brands trying to reach those customers, and by locking those customers into memberships, Walmart is effectively building a high-margin digital ecosystem on top of their traditional low-margin retail base.
The physical stores and the cheap groceries are basically just the Trojan horse.
Exactly.
They get you in the door or onto the app so they can sell you into the high-margin digital ecosystem. It is an incredible pivot. But I don't want us to get completely blinded by the AI and advertising hype.
Fair enough.
We have to remember that down here on Earth, the physical reality of moving those goods still comes with heavy macroeconomic baggage.
It absolutely does. The physical supply chain is still vulnerable to real-world friction, and the Q1 earnings report highlights several major headwinds that investors need to carefully consider.
Let's look at those headwinds because they are significant. First up is the fuel problem. The sources highlight a major drag on Q1 operating income. There was a $175 million negative hit due to higher-than-planned fuel costs in their global distribution and fulfillment operations.
which is the hidden tax of their delivery success.
Yep.
If you are rushing thousands of deliveries to front doors in under 3 hours, you are burning a massive amount of fuel. The report notes this was a 250 basis point hit to their operating margin.
For the listener, let's ground that jargon. A basis point is simply 1/100%. So a 250 basis point hit means their operating margin took a 2.5% haircut simply because diesel gas cost more than they modeled for.
Exactly.
And management explicitly warned that if elevated fuel costs persist, they will have to pass those costs on to the consumer, meaning higher retail price inflation later in the year.
And then we encounter the paradox of retail pricing. The sources highlight what they call egg price deflation.
Okay, I have to stop you there. Because for you and me at the grocery store, cheaper eggs are fantastic news. I love egg price deflation.
We all do.
How on earth does Walmart view cheaper eggs as a 100 basis point headwind to their like-for-like food inflation numbers?
It comes down to the ratio of fixed costs versus variable revenue.
Okay, walk me through it.
Imagine a shopper comes in every week and buys 1 dozen eggs. Last year, those eggs cost $4. This year, due to deflation, those same eggs cost $2.
The shopper is thrilled.
The shopper is happy. But Walmart just collected $2 less in top-line revenue for moving the exact same physical item.
Ah, I see. The revenue drops, but they're fixed, cost the electricity to keep the store lights on, the hourly wage of the cashier, the fuel to drive the eggs to the store. None of that got cheaper.
Precisely.
So their profit margin compresses because the revenue shrinks while the operational costs remain identical.
You've got it. It mathematically suppresses the overall revenue and margin numbers. And there was another unique macroeconomic roadblock mentioned in the sources: maximum fair pricing legislation.
Let's translate that out of corporate jargon too. Basically, new state or federal legislation capped prices in the pharmacy department.
Right.
Walmart is legally restricted from charging market rates for certain health and wellness products, instantly freezing a chunk of their revenue growth in that specific aisle. That was another 100 basis point hit.
It all adds up.
So you have fuel costs eating profits, deflation in staples like eggs artificially shrinking revenue, and new legislation capping pharmacy prices. All of this friction led to Walmart slightly lowering and adjusting its full-year fiscal 2027 EPS guidance.
They brought the full-year guidance down to a range of $2.75 to $2.85 per share. That is notably lower than the Street's estimate, which was sitting at $2.91.
So what does this all mean? I really have to push back here on the market's logic. If fuel is eating into their margins and they're openly warning about inflation and their full-year guidance is materially softer than Wall Street expected, why are analysts overwhelmingly telling people to buy the stock?
It does seem contradictory.
I mean, I'm looking at the MarketBeat source, and the consensus rating is still a rock-solid buy. They have 30 buy ratings, 2 strong buys, and only 2 holds, 0 sells.
And the price targets are even more aggressive.
Exactly. Oppenheimer and Wells Fargo currently have their targets at $140. BT High is at $145. Citi is at $147. And TD Cowen is pushing their price target all the way to $150. How does a company lower its earnings guidance, warn about fuel costs, and get rewarded with $150 price targets?
This raises an important question about how institutional investors view time horizons compared to retail investors.
Oh.
If you are a day trader or a retail investor, you might panic over a single quarter's lowered guidance. Institutional analysts, however, are generally looking far past short-term commodity fluctuations.
So they view the expensive diesel fuel and the cheap eggs as just temporary noise.
It is entirely cyclical. Fuel prices spike and drop. Egg prices eventually stabilize. Pharmacy regulations adjust over time. What is not cyclical is the structural, permanent margin improvement we discussed earlier.
The automation and the ads.
Yes.
Yeah.
The analysts at Citi and TD Cowen are modeling out the long-term compounding impact of having 50% of all fulfillment automated by robots. They're modeling the compound growth of an advertising business that's currently expanding at 37%.
And the AI.
And they are looking at Sparky, the AI, driving a permanent 35% increase in order values.
So the analysts believe the incredibly high margin revenue from ads and memberships will eventually vastly outpace the low margin drag of the physical retail side and the temporary fuel spikes.
Exactly.
They aren't looking at the weather report for next week. They're looking at the foundation being poured for the next decade.
They're buying the transformation narrative wholesale. They believe the transition is permanent.
Which brings us full circle back to that 48 PE multiple. Paying that kind of premium requires absolute faith from the listener that this tech transformation isn't just a pilot program, but the new normal for the entire enterprise.
It really is an incredible evolution.
It is. I mean, we started this deep dive looking at WMT as a traditional discount retail stock. But
Yeah.
the data in these earnings calls clearly outlines an omnichannel, AI-powered tech and logistics platform that just happens to sell physical goods as a way to acquire users.
It is a masterclass in how a legacy company can leverage massive physical assets in an increasingly digital world.
But amidst all this talk of robotic grids, algorithmic efficiency, and AI shopping agents building barbecue carts, I do want to leave you with a very comforting, very traditional piece of investing news that was tucked away in the sources.
Ah, yes. A little return to normalcy for the traditional investor.
Exactly. Walmart recently announced that it just raised its annual dividend to 99 cents per share. That marks its 53rd consecutive year of dividend increases.
Over half a century of steadily returning cash to shareholders. It is a vital reminder that beneath the shiny high-tech transformation, the underlying cash generation of the core business is still incredibly robust and dependable.
53 years of financial consistency, operating right alongside 30-minute automated drone deliveries. It really is a fascinating intersection of the old economy and the new economy. It certainly makes you rethink what a tech company actually looks like.
The definition is definitely blurring.
It really is. And that is exactly what we want to leave you pondering today. If a 60-year-old traditional brick-and-mortar grocery chain can successfully transform itself into an automated, AI-driven advertising and logistics network commanding a massive valuation multiple, well, what other boring legacy industries in your portfolio are quietly becoming tech giants right under our noses?